Good morning, and you're watching Buy Now, Sell Now on ET Now with me, Vinny Motiwala, along with me, Cheryl D'Souza as well. Cheryl, a very good morning to you. And markets just seem to have slipped in the red as of now.
Actually, they have, but it's muted trading session coming through the benchmark indices. Remember that we saw a sharp dip yesterday, but today we are actually trading flat with a negative bias as we speak. You have Nifty Bank that's holding on to the positive territory in today's trading session, right now at least. Talking about some of the Adani Group companies, they are trying to make a good comeback. Look at Adani Enterprises seeing an uptick of about 14% as we speak. You have Adani Ports that's seeing an uptick of about 7%. Adani Power had a block deal take place today, 0.4% equity traded hand, multiple block deals. So on back of that, you have Adani Power that is in focus. However, the stock is subdued in today's trading session. Talking about other list of gainers, you have Dr. Reddy's and Bajaj Finance. They are seeing an uptick of about 1%. Add to that list, even Kotak Mahindra Bank is trading higher by about 1%. Post that, you have IndusInd Bank and HDFC Life, which are seeing muted gains. Talking on the flip side, it is the metal index that's under immense pressure. Tata Steel is reacting on those numbers. Hindalco is reacting on Novelis' numbers that were released yesterday. So both of them seeing a sharp downtick. ITC is taking a breather after that spectacular rally that it had witnessed. So you have ITC that is down 2.8%. Hero MotoCorp is subdued ahead of earnings, as well as Tata Motors that's down about 1.5%. Let's take a look at what are the other sectoral indices doing in today's trading session. Like I mentioned, you have Nifty Bank that's holding on to some marginal green, but on the flip side, you have Metal Index that's the top sectoral loser, followed by FMCG, Auto, as well as you have the broader markets that is underperforming the benchmark indices. Primarily, it's a small cap index that's trading low by about 0.6% as we speak. Also, you have a mid-cap index that is in the negative territory. But on the gaining side, you have the energy index that is seeing an uptick of about 0.2%. Realty as well, that is seeing an uptick, but not such a decisive shade of green on realty and IT in today's trading session. But there's one stock that is shining exceedingly bright in today's trading session, and this is after a really long gap, isn't it, Vinny?
Absolutely, and that stock, I think we don't require much guessing. It's Paytm, it's passing in trade. We saw it actually touch almost an increase of around 20% in today's trading session. Let's go across to my colleague Sharad, who is here to decode what is happening in Paytm. What is the reason behind this move as well, Sharad?
Well, yes, Paytm is actually the stock of the day, we can say, and a very strong buying coming in the last half an hour of the trade as well. Now, do remember that the stock over the last two sessions has gained almost more than 20%, and from the November lows itself, if you see, the stock is up more than 40%. But why the rally is happening? The question is, last evening there was a con call taken, and over there, Vijay Shekhar Sharma had clearly stated that the company recently had actually got their EBITDA guidance actually ahead of 3 quarters, and this is the profitability numbers which was coming in. Now he's stating that this might be a double-digit growth might be there in the future, but not has given any timeline to it. And secondly, this will be sustainable. Apart from that, the regulatory risk management will be the topmost priority for the company itself, and they have also stated that the day is not far where the regulation issues, especially pertaining to the payments and the services banks, would be actually solved with the RBI. Apart from this, there was no incremental guidance given for the free cash flows going ahead, but also they have mentioned that they would be still investing in growth and marketing, but this will be funded on an internal basis. Now, overall, if you look at the numbers also, the company actually turned EBITDA positive after adjusting the ESOP cost. Almost 32 crores of EBITDA numbers have come in. The losses narrowed down from 700 odd crore to 392 crore. Revenue rose up almost 42%, and the markets cheered the Q3 earnings. Apart from this, even the Goldman Sachs actually reiterated their buy rating and actually increased their target price from almost 1120 to 1150 rupees per share. But now this is the entire picture of Paytm. But important thing is what lies ahead for Paytm and what are the important triggers for the stock. And of course, the first one being is the resolution of the Paytm Payments Bank with the RBI, and also the payment aggregator issue which is there, and how the company gets its authorization. And lastly, also the guidelines on the payment charges would be very important to follow, and of course the path to profitability which the company is going on.
All right, thank you so much for that, Sharad, for outlining what actually worked for Paytm. The key question, what will work for Paytm going ahead? But that's a point that we will discuss later on the show with our experts. But for now, let me bring on board Kunal Bothra as well as Rajesh Agarwal. A very good morning to you, Kunal, as well as Rajesh. Thank you so much for joining us on ET Now, especially on Buy Now, Sell Now. And Rajesh, let me come first to you. Yes, we did hear about Paytm, but my question to you is on the market as a whole. What should retail investors do in such a market scenario to make sure their wealth is protected? Because we thought the volatility will only be limited to the month of January, but it seems to have been prolonged.
Good morning, Shail. Good morning, Vini. Good morning, Kunal. You said it right. The volatility which was expected to be there in January has continued in February also because of all the news flows, which we all know, the budget followed by Adani things, and all those things have made investors jittery. But uh, in such kind of scenario, what I've seen, most of the investors start thinking irrationally, I would say. They start to panic. And yesterday only, a client of ours who has a good holding in banking was so panicked that he just wanted to get out of one of the biggest bank in the country, not only in equity, but also he wanted to premature his fixed deposit. That was the kind of panic which we saw. So that's not something to do. We should try to not to run after every news that comes in. It's a natural instinct to react and protect investments from further declines. But the major quality what an investor needs is to act calmly and rationally and think logically. See, what has Infosys to do with such kind of scenario? That company has nothing to do, but we have seen correction in that also. So one has to see whether that company is going to be affected by the news flow, or if the news flow is genuine, or it's going to take a long haul. So these things has to be taken care of. You know, sometimes required not to do anything. An experienced batsman doesn't try playing all the 6 balls, I would say. One should stay calm, stay put. If your portfolio is good, if your investments are good, don't try to do anything. Don't panic. If you're not comfortable putting new money, at least don't sell your good stocks.
Okay, that's the view coming in from Rajesh on how one should be actually looking to protect themselves from this volatility. But on that note, we're going to slip into a very short break. Don't go anywhere, because after this break, we will be taking all your stock-related queries.
Welcome back. You're watching Buy Now, Sell Now on ET Now, at the show where we get you all your stock-related questions answered by a team of experts. And today our experts are Kunal Bothra as well as Rajesh Agarwal. And you can tune in to YouTube, Facebook, Twitter handle, or even you can log on to etnownews.com where we are live and you can write your query to us. Also, you can connect to us via WhatsApp number that will be flashing on the top of your screen. So let me get going with the queries that we already have. We have the first one coming from Harsh Ranjan, and he's holding ITC from the level of 250 rupees per share. He's saying that he can hold on for the next 3 years. He wants to know whether he should stay put with his investment or switch to another companies. And yes, Rajesh, I can see the smile on your face. And every time you're on the show along with Kunal, and every time I ask this ITC question, I can't help smiling, because I know Kunal, who's standing on top of his building terrace in Mumbai and has been screaming buy ITC, and I believe he continues to do so, while you shouting on the rooftop in Kolkata saying that buy ITC. Are you still screaming that?
Yes, of course. I'm still with ITC. The numbers have been pretty good. 6 rupee interim dividend has been declared. Numbers have been pretty good in secret division also, along with FMCG. Both divisions are doing well. The kind of travel going up, we are witnessing good traction in hotel business also. Everything is doing well. The valuation to see it's still trading at 18, 19 odd times current year earnings. So that's still a huge discount to other FMCG players. One can still go long in this stock for a period of 3 to 4 years. I don't deny the fact that there might be some moment of consolidation or correction after this kind of stellar run-up. But for somebody who's willing to hold for 2-3 years, yes, it's a stock which should be there in one's portfolio.
Okay, and like Cheryl was rightly pointing right now. Kunal was upset that ITC, he didn't get to scream it one more time that why is he liking ITC? Kunal, what's your target for ITC before I come with the next question for you?
Well, just few days back, I just softly screamed about the 400 plus mark for ITC. I maintain that bullish stance, and I think it's a good time where traders should probably try and accumulate further. I think the stock delivered, decent results. The reaction post results, post budget was quite positive. Even though the stock is, showing a negative price action today, possibly the stock may correct till 365 levels, but that should be a good point where traders could look to accumulate further.
Okay. Kunal, now I'm going to come with a question which is actually on the Adani Group stocks. We have a lot of them coming in, so I'm just going to combine them and talk. One is coming in from Akash, and this one is on Adani Enterprises. They're making a very good gain on this of around 50%. And obviously today we have seen a sharp run-up coming here. So what should they be doing with Adani Enterprises? The next one is on Adani Ports. If someone is holding it at 900 rupees per share, should they average hold exit? And is it the right time to enter Adani Ports as well?
Well, Adani Enterprises, I think if it's a more of a trading profit, which I believe it is, I think it's a good time where you should look to book out profits, trail your stop losses. Those are the routine disciplines which we advise clients as well as traders to try and adhere towards. So you may have a 5% to 10% kind of a trailing stop loss for Adani Enterprise, and you can keep on riding the trend for the balance, assuming if you're booking say 50% of profits. Adani Ports, on the other hand, I would believe so the two stocks which I predominantly like from the entire Adani pack, one is Adani Ports and the other is Ambuja Cement. I think both these stocks are more strong as well as formidable, and I think if you're looking to average out, then I think both these names are the ones which you should look to average typically. So I would sense that if you've bought at high levels of 900, stock is currently at 550 plus levels, good time where you should look to average further.
Right. This one is coming from Ram Shankar, and this one is for you, Kunal. He's asking, is it worth holding on to Balaji Amines as well as Aarti Industries after the heavy fall today? He's already facing a loss of about 25% in both of these counters. So he wants to know, is there technical support nearby for these counters in order to average out?
Yeah, I think the stocks are significantly divergent from their long-term average. Now, I'll give an example. For example, Aarti Industries, the 200 DMA is around 725. The current market price is at 530 levels, which means there's a divergence of almost 30% to the stock price. Such divergences, they don't tend to stay for a longer period of time, and there is bound to be a point where the stock gets into a mean reversion phase. I believe possibly the market trigger could be the only trigger. So assuming if the index stabilizes and if you see a breakout on the upside, that could be a point where most of the stocks which are significantly below their long-term averages, whether it's Aarti Industries, Balaji Amines, etc., these stocks could also go into a strong recovery phase. So I think it's a matter of time. I would suggest that you should look to just hold on to your existing quantity.
Okay. Rajesh, I'm going to come to you also because we have certain queries on Balaji Amine and which is on the fundamental front as well. One is from M. Mohan from Tanzania, and this one is on Balaji Amines. They are holding 112 shares at a price of 3,136 rupees. So, what is actually happening in the share and why was there a downtick that they're seeing? They want to understand. And also Shailesh from Madhya Pradesh is holding 50 shares of Balaji at around 3,000. So, both of these investors, should they continue to hold? Should they sell? What is the fundamental view now on this one for a long term?
Fundamentals are very strong. The only problem is the kind of performance which we have witnessed in the COVID period for all the chemical companies. That mojo has gone, and it's only normal performance which is going to continue. That's the only reason we are seeing the underperformance. First, second, with the kind of run up, it's bound to take a long consolidation. But as Kunal just pointed out, just a matter of time when these stocks start performing, because the prospects are still good. The China plus factor is still there. And I think going forward, the numbers are going to be good, not only in Balaji, but in Alkyl Amines and other chemical stocks also, because of the kind of expansion they have taken, the kind of business prospects. It's just a matter of time. You just carry on holding these stocks.
Okay, Kunal, Manish Raju wants to know whether you recommend buying DCB Bank and Bajaj Finserv at current market price for the short term.
I think Bajaj Finance is something which I have advised, and I believe even Bajaj Finserv moves in very similar kind of a fashion as compared to Bajaj Finance. So you can look out for buying Bajaj Finserv. Bajaj Finance would be a slight preferred bet, just because of the way the stock tends to move and the leadership quality as compared to Bajaj Finserv. But then, of course, you can look to buy either of them. DCB Bank, on the other hand, I think is forming a good base at this 110 112 mark. I think the last week or so, the low for the stock was just about that 105 mark. It also managed to protect its 200-day moving average, at least so far, even in the last 1 or 2 months of the price correction for DCB Bank. So that could be a point where maybe the stock is just trying to complete a mean reversion phase and stabilize about the 105 mark. So the risk reward is in favor for you initiating a buy on DCB Bank as well.
Rajesh, the next query is on ISGEC Heavy Industries. This query is from Raman from Chennai. They want to know, is it a good time to buy this stock for a long term?
See, I don't find any reason to be in the stock for a longer term because one, the volumes are very low. The numbers are not that consistent. It's better to be in some known names. If you want to be in engineering, maybe a Thermax or a Siemens would be a better bet than going for ISGSA. These kind of stocks just give a temporary short-term trading opportunities, I would say. And when that kind of thing happens, you can always get in and get out. But for longer-term holdings, I would suggest Siemens or Thermax.
All right, this one is coming from Santi Chedela, a bit of a longish query because it's a two-part query, and this one I believe will be for you, Kunal, instead. Gland Pharma is a counter holding about 48 shares at a price of 1,863 rupees per share. Wants to know whether he should look to average the stock around 1,200 or below. He wants to know whether his decision on this will be correct or not. One is that. The other thing he wants to know is he wants your view on the strategy that he should follow to move to a profitable level. Would averaging out Gland Pharma be a right option, or should he look to trade in the counter instead to make some profits?
See, I think first come first, the stock is at a major corrective phase. It's already corrected, I think, from 4,000 levels to now 1,200 plus, which means a correction of more than 50 to 60%, more than 60% for Gland Pharma. So I think in that regards, the stock has already gone through a very steep correction. Now, in such kind of a scenario, you should not be attracted towards price levels, but you should be always attracted towards any kind of a comeback or a fight back from the prices. So assuming if the stock, over the last 1 or 2 months, the stock has just been sliding or going into a downward trend. You have to wait out for a point where the stock gets into a strong recovery phase, even if there's a 10%, 12% kind of a sudden recovery, but that would earmark a major support for the stock, and that would probably help you develop a strong risk reward to try and initiate a fresh buy. As of now, it'll be a bit unsure whether the stock slides towards 1,100 or even 1,000 mark before it finds a credible bottom. And because of the weight of averaging, you would be left with a lot of stocks at higher levels. So I would suggest that you wait out for a point where the stock gets into a bounce back process, and then establish a major support, and then look out for trading the stock as well as averaging.
Rajesh, this next query we have is coming in from Chetna Shah from Kenya, and this one is on Sumitomo Chemicals. They're holding 1,000 shares. What should they be doing with it? They've not given a buy price of that. Should they continue to hold them or sell?
One can continue to hold, even one can add at these levels because valuations have become quite attractive. The company is doing very well, and with the Japanese partnering, I think it's a very good stock for a long term. One can buy this stock with a target of maybe 520, 525 odd rupees in the next 1 year.
Okay, this one is for you, Kunal, and this one is coming in from Soumitra. And he's asking you that once you had suggested a buy and a hold on Muthoot Finance, while a sell on Varun Beverages earlier on. He's saying from there on, if you look at it, Muthoot Finance has instead fallen, while Varun Beverages has actually risen from there on. Has this sort of a move in both of these counters made you change your view on both of them?
So not really. In fact, just about a month or so when Varun Beverages was actually at 1,400 odd levels, that was exactly the time when I reiterated my point that Varun Beverages would go into a corrective phase. There is a lot of divergence at play for the stock. It had fallen to almost 1,020 and now risen from the 1,020 levels. Muthoot Finance, yes, the stock has gone through a shallow bit of correction, but I believe that the stock is forming a major base time-wise correction. In fact, even Manappuram Finance has started to look very attractive. So I would still stand by with the stance that Muthoot Finance and Manappuram Finance as well of late have been looking very attractive, and Varun Beverages can probably go into a corrective phase and come back towards at least the 200-day moving average, if not below that.
Okay, on that note, viewers, we're going to slip into a very short break, but don't go anywhere. We'll be taking your stock-related queries even after this break. Welcome back, and you're watching Buy Now Sell Now on ET Now. Let's keep it going with your stock related queries. The next one is coming in from Sandeep from Punjab. This one is on FTC Limited. They have 200 shares of FTC at 266 rupees, and they have 300 shares of India Cement at 227 rupees. What should they be doing with both of these stocks, Kunal?
Well, would not suggest an averaging out for both of these names. They are so India Cement specifically. The stock is going through a very sharp kind of a downtrend from 280 levels. The stock is at 180, 85 plus levels. So the correction has been quite steep over the last 4-5 months for India Cement, and it doesn't look like that the correction is stalled for the stock. Same would be the case with FDC. The only reason for not suggesting an averaging out for FDC is because the stock is going through a very shallow kind of a correction. It's struggling to hold above its 200 moving average, and I think the price trends are nothing materialistic. There's no major patterns emerging from volumes as well. So I would believe in that regards, you should just look to avoid both of these stocks, at least averaging as of now.
Okay, the next one is coming for you, Rajesh, and this one is from Lalita. She's saying that she's a value cum growth investor, and recently, after the research that she did, she decided to invest about 50,000 in Thyrocare at around 500 rupees per share for a period of 5 years. Now she wants to know whether it makes sense to remain invested in this particular counter or switch.
See, the problem with these kind of diagnostic companies which had a stellar run in COVID period is, one, the COVID has gone and the kind of revenue they were earning from that has gone. Second, there is a lot of competition. We have seen many online players like Tata One MD and all giving very good offers which have put pressure on these kind of companies, and this is going to continue for some more time. I don't find any reason to believe that this competition is going to go away in a very short period of time, whether it's going to be intense. So my suggestion would be to keep Thyrocare or Metropolis or Dr. Pathshala, these kind of stocks for a short-term portfolio where maybe you get trading opportunities a good 10%, 15% upside, you book out. For a longer term horizon, healthcare, if you want to be there, there are good hospital chain names like Apollo Hospital or Narayan Hrudayalaya, even Rainbow Medicare. These kind of stocks could be a good bet for a longer term portfolio.
Okay. The next query is on Infosys. Kunal, this one is for you. The viewer has bought 600 shares of Infosys at around 1,550 rupees. This was somewhere in the last year. Now they are saying that what should they be doing currently? Should they look to exit the stock or continue holding? The maximum time they want to still hold for is just almost 12 months now, not more than that.
Yeah, I think you should continue to hold on. I think the IT stocks and the sector is trying to indicate some sort of a reversal, positive reversal for itself. Now, the leaders so far in this rally have been the likes of HCL Tech and TCS in that order. So, I believe both these stocks can stand to outperform. Infosys is lagging behind by a bit, but possibly that lag, it can cover up that lag possibly in the next 3 to 4 months. So, you can look to hold on to Infosys. It's also above your buy price. It's also trading above the 200 moving average. So, I think in that regards, you should continue to hold on.
Okay, this one's coming from KJ Singh. Long-term view he wants on Amber Enterprises. He's purchased at 2,700 rupees per share. Wants to know whether he should average some more at current market price. What's the take on this one, Rajesh? First of all, makes sense to remain invested in Amber Enterprises, and if yes, then should he look to average right now?
Long-term looks good. The company is doing well. The model is good. But the only problem is the valuation is still stretched after the kind of correction it has witnessed. It's still trading at a very high valuation. So averaging at this point of time would not be recommended. Maybe 1,500 odd levels, if by chance it comes, then one can average. But for a longer term portfolio, yes, one can continue to.
The next query is coming in for you, Kunal, and this one is from K. Venu Gopal Reddy from Hyderabad, and this one is on Tata Power. They're looking to average Tata Power. Would it be advisable at the current market price if they've bought at around 233 rupees previously?
I think sub 200 is a good level to average Tata Power. I think time and again over the last many quarters as well, I've maintained that stance at sub 200 levels, maybe 180, 195 approximately is a good zone to average Tata Power. That's where the stock tends to find major support. Even if you look at the last 2 months of chart from December, January, the stock had 2 attempts to cross below the 200 levels. There was a very sharp correction which happened intraday, but the way the stock has recovered from those sub 200 levels to 210, 12, 10, 15 mark, I think was very, very quick and sharp. That indicates that sub 200 is a good zone to buy the stock rather than at current levels.
Okay, this is from Satya and he wants a view on Vedanta, whether he should hold or exit. Kunal, his buy price is 308 rupees per share. He wants a 3 to 6 months view.
Well, I would suggest to hold on. As of now, it's still holding on to the 200 moving average. I would suggest that you can probably keep a stop loss maybe closer to 294 levels for Vedanta on the spot basis.
Rajesh, V Bharat is holding Tata Consumers at 795 rupees per share. Whether is it time to average this or not? What's your fundamental view?
See, the fundamentals are very strong. The product profile is very good. They have a merger pending with Tata Coffee, where Tata Coffee would be merged with Tata Consumer, and then again it would be a much larger portfolio. For a longer term, by them, we have a target of 850, 870 odd rupees in the next 1 year after the merger and all. So any corrections should be taken as an opportunity to add to this counter. It's a very good company for a longer term horizon.
Okay, the next one actually, the viewer has asked for Kunal's view, but instead I will take this to you, Rajesh. Vasu has asked for Relaxo for the longer term as an investment. How does it look? He wants your views on this one. Also, given the fact that how the particular counter is moving right now.
See, the numbers have been pretty bad. The kind of expectation that was built up with Relaxo has not been met. Rather, the numbers have been pretty disappointing, and I don't find any reason to think that the numbers are going to be good in the near future. There are good stocks in the footwear industry, I would say, either with Bata or a Liberty, that would be a better bet than Relaxo. So if somebody is holding, any upside should be taken as an opportunity to exit.
Kunal, this next one is on Real Vikas. This query is the viewer is holding 500 shares of Real Vikas at 68 rupees per share. They bought it in December. How does it look like for the next 6 months if they want to hold it?
See, I think it's time to try and book out profits from these kind of names now. Even though they may look very attractive from long-term play, but the only fact that when the markets are into a phase of choppiness as well as sideways price action, it's bound to be a phase where these stocks which have done exceptionally well, even they would go into a corrective phase. So, I think it's always better that if you're sitting in profits into these kind of high beta stocks, it's always good to take out profits over there and then look to buy back again or deploy the amount back again when the stocks go into a corrective phase. So maybe if the stock corrects below that 60 level, that could be a point where you may look to come back again to the stock.
Okay, Kunal, the next one is a very tricky question, or rather a question that we don't get asked most of the time, and this one has come from Swayam. He wants to know Alok Industries or Snowman Logistics. He wants to take a risky bet.
I would not suggest either of them.
All right, so you should not be risky in such a market, isn't it?
Absolutely, absolutely. It doesn't make sense to try and look out for high punts into these kind of stocks because it's not just 50-50, but I think the risk reward is not at all favorable. There are times, so what happens is we've seen 2020 rally, we've seen 2021, and then we tend to expect that every year we are going to and we are bound to have such kind of a V-shaped recovery, but that's not the market which we tend to face. 2020-21 was exceptional. It happens just once in maybe 20 years, 15 years or so on an average. We can't expect those kind of returns as well as strategies to work out every year. This is the kind of normal markets which tends to happen and tend to trade for many years to come by.
Exactly, and it's a very pertinent point. Just because you saw those gains in the year 2020, you cannot expect that to actually recur year after year and time after time. You shouldn't be so risky in the market. In fact, take a very sound investment bet in the market, and this is the way how the normal markets function. It is marred with more volatility. It is marred with maturity is what you should actually invest in. But on that note, thank you so much, Kunal, as well as Rajesh, for joining us on the show for actually taking all of our viewers' queries, resolving those queries, as well as sharing your bits on what they should do in the markets. But let's move on and let's actually bring on board the management of JK Paper. Remember, the JK Paper had reported its earnings, and if you look at the consolidated profits, it's seen a sharp uptick on a year-on-year basis, coming in at around 329 crore rupees versus 150 crore rupees. You also saw 50% uptick in the revenue. The margins also have actually exceeded coming in at around 34.4% versus 29.4% on a year-on-year basis. So let's bring on board Mr. Veerapan KR, who's the CFO at JK Papers, joining us on the show. A very good morning to you, sir. Thank you so much for joining us on ET Now. First of all, congratulations on a very healthy set of numbers in the quarter gone by. And firstly, I want to ask you that will we see the demand for paper and packaging segment continue to remain strong in the quarter that we are in? That is Q4, and also what's your views for the entire packaging segment?
Well, good morning, and thank you for having me in this show. And yes, the results have been pretty good this quarter, and the demand has been quite good as far as the printing and writing and printing segment is concerned. As far as packaging board is concerned, there has been a slight downward trend in the demand. And Q4, we expect to remain the same as far as the copier and Maplitho is concerned. The demand is expected to be good, and the board is likely to be tight.
Right, so this is Winnie joining in the conversation as well. Very good morning to you. What we also want to understand is in terms of your realizations. Do you think this realization growth will sustain in Q4 as another company is not taking price hikes in most categories, right?
Yeah, the price has remained stable in most except for boards, where there has been a slight drop. And Q4 also, we expect to sustain the same levels, and the boards will continue to be under a little bit pressure. So there may be a marginal drop in the boards.
Right. So what about your input costs? Have they started to ease off right now? And if yes, what will be the outlook on the margins that you have coming in for Q4 as well as for FY24? If you can share any guidance on that particular front for us?
Yeah, Q4 input cost may slightly come down, and coal prices are coming down, and pulp also a little bit. Whatever our pulp cost is has been stable so far. So overall, the margin levels, I would say, we will try and maintain that. Yeah.
Right. And also, what about, market share? Because you've said that, you have increased market share in Q3. So could you just give us an understanding on what is the market share that we would be looking at from the company in 2023 as well as in 2024? What are you targeting for the market share then?
Yeah, market share, I will not exactly pinpoint some numbers. It will be around 28 to 29%. And basically, I'm talking of the writing and printing copier segment. And so there we have really improved in the copier as well as in Maplitho. And boards also slightly we have improved. So the same levels will continue by the end of this year also.
Right. Let me talk about the acquisitions that you've done in the quarter gone by, and if you could talk about the synergies of these acquisitions, that is Horizon Packs and as well as Security Packs Packaging. By when, also apart from that, by when will the Ludhiana plant commence its production for corrugated paper?
Yeah, first let me talk about Ludhiana plant. Ludhiana plant is expected to commercialize production sometime at the end of this year. So definitely, and I think lastly, we had mentioned last time also that we had made a detailed study for the last 3 years through external agency, and we identified corrugated packaging is a very growing, high growth segment. And that's one of the reasons why we put up an investment in Ludhiana. And that plant is coming up well and expected to commercialize by end of this quarter. And we had plans to expand pan-India level. And in the meantime, we did have an opportunity to acquire these two companies, Horizon Pack and Security Packs Packaging. And they are present, both companies put together, they're present in 7 locations across India. So that has really added well for our plans, and it has only strengthened our position and accelerated our plans.
Okay, sir. Thank you so much for joining in with us this morning on Buy Now, Sell Now on ET Now. It's a pleasure having you on the show. That was the management of JK Paper for you all, Veerapan KR, the CFO of the company. But on that note, we're going to slip into a very short break. Don't go anywhere. We'll be back with more details after this. Make financial matters simple for our viewers. Keeping up with our values, we present the second season of Nivesh Ke Funde. On this edition, we discuss India's economic growth and how that can benefit you. Let's go across and listen in.
Hello and welcome to yet another edition of Nivesh Ke Funde. I'm Ajay Sharma. Now it's a well-known fact that India's economy is on a very strong growth trajectory.
Yes, Ajaya. In fact, India is considered the fastest growing emerging economy across the world.
But Kavita, how can the everyday Indian be a part of this growth story? And what are some of the avenues that they can explore.
Now, one of the relatively easier and simpler ways to do this is to invest through mutual funds.
Absolutely, mutual funds provide the investor an avenue to invest in multiple asset classes.
Yes, Ajaya, through mutual funds, an investor can get access to equity of shares of the Indian stock market as well as global stock market.
Not just equity, they can invest in bonds and debt market and even invest in gold and silver through the mutual fund route.
Right. One more thing, Ajaya. By investing through mutual funds, a person can invest in small denomination and does not have to make large investments at one go.
Yes, this helps the investor continue their investment at regular intervals for a long duration of time. Additionally, when a person needs money, they can redeem the mutual funds unit worth the amount they require easily.
Absolutely. One does not have to sell the entire investment. Thus, one gets the benefits of liquidity and flexibility also.
So if you believe in India's growth story, make sure you're a part of it. And the easy way to do that is by investing in mutual funds.
And with that, that's all on this edition of Nivesh Ke Fun Day. Thank you for watching.
And on that note, we're absolutely out of time on this edition of Buy Now, Sell Now on ET Now. Thank you so much from myself, Cheryl, as well as the team who put this show together. Don't go anywhere. Markets and Noon will take the action forward.